Hello and welcome. In this video, we are looking at a consolidation-based question, in particular, consolidated statement of financial position question called prospect group. Let's read through the requirements first, and then we'll read through the information that is given to us. So the question requirement is to prepare a consolidated statement of financial position for this group called prospect group. As at 31st December 2018, we need to show our workings very clearly. Okay, good. So what is this about? We have been given financial statements of three companies called Prospect, Sincere and Absolute. And for that we have non-current asset, in which we have property, plant and equipment. There is an investment in Sincere in the Prospect's books, an investment in Absolute in Prospect's books. So looks like this company, Prospect, is investing in the other two companies. Okay. Then we have current assets, equity, which includes share capital and retained earnings. We can assume these are the ordinary share capital. Non-current liabilities and current liabilities, which includes payables. Good. Additional information. Prospect acquired 16 million shares in Sincere on 1st January 2018 for £30 million, where the retained earnings of Sincere were 600,000. Okay. On the same day, Prospect also acquired 2 million shares in Absolute for £11 million, when the retained earnings of Absolute were 300,000. Great. Number two, on the date of acquisition, all assets and liabilities of Sincere were equal to their fair value except for a piece of land. The fair value of the land was 10 million higher than its carrying value. Now, according to IFRS 3, when we are working out the initial phase of acquisition, all the assets and the liabilities of the subsidiary of the company being acquired should represent their fair value. If any of the assets were not at their fair value or liability, we need to change it to the fair value. This is what is happening over here. There was a piece of land in Sincere. When Prospect acquired it, the value of that land, the book value of that land, was 10 million lower than its fair value. Okay, so we need to account for it. And it is safe to assume that Sincere has since then not included that extra 10 million in accounts. So the property, plant and equipment is still lower by 10 million. So we need to add 10 million to that. Number three, the goodwill in Sincere was impaired by 10% at reporting date. Now, so kind of telltale sign that which company is a subsidiary in this case. We can still work out the group percentage holding of the subsidiary. Okay, but it looks like Sincere is the subsidiary. The goodwill was decreased by 10%. Number four, non-controlling interest is valued at full fair value. So there are two methods of valuing NCIs, or non-controlling interest. One is fair value, where they are reported at their fair value, and plus they will get a portion of goodwill. And the other method is proportion of net assets method, where they are reported at their percentage shareholding in subsidiary multiplied by whatever net assets of the subsidiary on the given date is. Alright, so there's a difference. It's the companies have a choice in terms of which policy they want to adopt. So this company has gone for full fair value. And the value was 8 million. So they are reported at market value, 8 million on the date of acquisition. At reporting date, it will change. How it will change, we'll see. During the year, Prospect sold goods to Sincere. Total value of the goods sold was 400,000. Prospect charged 25% profit markup at the year, and the 2/3 of the goods were still held by Sincere. So this is a classic case of intra-group transaction, intra-company transactions. So one company selling goods to another. So there is a possibility of intra-company current accounts existing between two, and according to consolidation principles, those accounts cannot stay within the consolidated financial statements. Otherwise, it will give wrong impression to the shareholders. Those need to be removed. And in addition to that, if there is any kind of unrealized profit sitting in the inventory which one company sold to another within the group, then that unrealized profit will need to be removed. Now in this case, Prospect sold goods to Sincere. Sincere ended up selling most of the goods, not most of the goods, some of the goods, but 2/3 of the goods still remain in the inventory at the year end, which means in that inventory there is still some unrealized profit sitting, so we need to remove that. Okay, so we have read through the information. Now we are going to prepare an answer. Okay, right. So perhaps first, if you are using pen and paper, leave first page for the consolidated statement of cash flow, and from the second page onwards you can start doing the workings, right? So let's start with the consolidated statement of cash flow, statement of financial position as at 31st December 2018. Okay, great. So I'm just going to do the workings on the sides over here so you can see what I'm doing, but for now I'm going to put everything in thousands. The very first working I want to do is, okay, let's do it slightly this side. Group structure. Working one is group structure. So first of all, I want to find out what is the share proportion of shares that parent purchased in Sincere, or prospect purchased in Sincere. And the question tells us that the parent or prospect bought 16 million shares. How many shares did Sincere had in issue on that day? Now, unless told otherwise, assume that Sincere or subsidiary has not issued any more shares since the date of acquisition. So whatever number of shares you can see in their financial statements are the number of shares existing on the date of acquisition. They had 20 million pounds worth of share capital. Each share was £1 each. So it is safe to assume that the company purchased 16 million working in thousand out of 20,000 shares. That means the shareholding is 80%, right? Because it is 80%, our NCI has become 20%. We can apply the same principles to the other company to find out what relationship parent has with that. Absolute. So parent acquired or prospect acquired, keep calling it parent. Prospect acquired 2 million shares, right? And they had 8 million shares in issue. Okay, so let's do the calculation. 8,000 divided by how many did we say? Sorry, 2,000 out of 8,000. Sorry, 2,000 or 8,000. So 25% shareholding, which means Sincere is a subsidiary and Absolute is what? It's an associate, because parent has 25% shareholding in associate. For a company to be an associate, parent company, the acquiring company must hold the shareholding which is between 20 and 50%. Anything more than 50%, it will become a subsidiary. Okay, so let's apply that, and we're working in thousands. Okay, so now we're going to prepare a skeleton of the answer, and then we'll do the workings, starting with non-current assets. Now, when I do the consolidated financial statements, I'm going to cross-cast the assets and liabilities of parent and subsidiary, right? I'm going to leave the associate out because associate doesn't get consolidated. Instead, we report investment in associate using something called equity accounting. So it will feature, but just as an investment in associate in one line in non-current assets. So for now, we are going to crosscast all the assets, all the liabilities of parent and subsidiary. So let's do that. Okay. So starting with, what do we have? Property first, isn't it? We have property, okay, which is 40,000 plus subsidy 16,000. Now putting them in the brackets and keeping the brackets open for the moment, just in case if we have any kind of adjustments later on, we can pass them through over here. We're not preparing any just a trial balance, so it will be done on the face of the answer. We have plant and equipment, which is a separate item, really. 24,000 plus 8,000. Again, keeping the brackets open. There are no other non-current assets in the question, because investment in Sincere, right, is going to be replaced with all the assets and liabilities that we are getting from Sincere. So Prospect is paying £30 million to get all the assets and liabilities from the Sincere. So we need to replace that 30 million with assets and liabilities on the Sincere. So we are merging that. So that will go. Investment in absolute will be replaced with a new figure at the end, which we will find later. Okay, so let's start with, let's not touch the investments here, but there will be a new figure as a result of this calculation, which is goodwill, and goodwill will come from a working. In our pro forma, the third working is for goodwill, so I'm going to label working 3. Then, because first one was group structure, second one was something else. Investment in this absolute or associate. Okay. Again, we need to do a working for that. We'll do working 6. Okay. Anything else? Not really. We can move on to current assets now. And in current assets, we have inventories. So that's 2,000 plus 2,400. There is definitely an adjustment affecting that. Then receivables, 15,000 plus 1,600. I don't think there are any adjustments affecting receivables, but just in case, we'll do the adding up at the end. Then bank, cash bank, okay, which is 3,000 plus 1,000. Alright, that's how we can find total assets. On the other side, we are going to be going to work out equity. And equity, we have ordinary share capital, which is going to be parents only, no subsidiary. Remember, we are replacing the investment in subsidiary with all the assets and liabilities. We don't want to touch the ordinary shares or any of the items from subsidiary. Ordinary shares, parent 90,000. Okay, then we have the retained earnings. So the retained earnings will be replaced with group retained earnings. Okay, and we'll do a working for that. In our pro forma, it's going to be working 5, and then we have known current liabilities. And for that we have 8% loan notes or loan stock. Okay, that is 30,000 plus 2,400. There are no adjustments, still going to leave it outside. Brackets open. Current liabilities including payable, 5,000 plus 3,800. Okay, and that will give us total equity plus liabilities. Okay, we can bring the totals here. That's over here. Okay, so skeleton is done. The pro forma of this consolidated asset is done. We're going to crack on to workings. Working 2 and working 3 will be for goodwill mainly, But other purposes as well, I'll explain in a minute. But working two is where we work out net assets of subsidiary in short sub. And we want to find that for two different dates. One is the acquisition date and one is the reporting date. How much the net assets were worth at the acquisition date so that we can use them in the goodwill calculation, and the reporting date so that we can take the difference between the two dates, call it post-acquisition profits of the subsidiary, and split that profit post-acquisition whatever subsidiary made between two parties. 80% claim will be for parent and 20% claim will be for the NCIs. Okay, so let's start with ordinary share capital subsidiary. From the question we know it was 20,000. We have used it. Retained earnings of the sub on both dates. Let's see. Note 1 says that retained earnings of the subsidiary was 600,000 on acquisition date, and at reporting date it has changed to 2,800. So retained earnings 600 and 2,800. And also, if we remember, there was a fair value adjustment. Some of the assets were not reflecting their true value, true fair value. So note number 2 say a piece of land was 10 million higher. So we need to increase that the value of land by 10 million and put that exact 10 million into the equity as well. That will be the two sides of double entries. Increase the asset, debit the asset, and credit equity. So let's do FVA, fair value adjustment. So this is acquisition date going up by 10,000 and reporting date going up by 10,000. And the same 10,000 will add to the piece of land which is sitting in the property. Okay, you can call it FVA as well. So we have done both sides of double entries. We can do the totals now. So that's 30,600. That is 32,800. We can even find the difference between two, which is the post-acquisition profit of subsidiary. We'll split it later on. So this is the difference. We'll call it post-acquisition profit sub. Right? We'll use it at a later point. Now let's move on to goodwill. Working 3. Goodwill. Alright, now we want to find out how much we are paying and how much we are getting in return. So we are going to start with P's investment. Okay. So P has invested how much? 30 million pounds in subsidiary. The same figure can be found in parents' financial statements. It's 30 million pounds. Let's use that 30 million. Okay. Working in thousands, by the way, let's put it right at the top that we are working in thousands. So we're working in thousands. Okay. Then, because it's a fair value method, we are going to introduce NCIs at fair value. Okay, and on the date of acquisition, the NCIs, note number 4 says were 8 million. So 8,000. Let's just take a bit of time understanding it. P's investment of 30 million is for the 80% of the subsidiary, and NCI's investment we assume is for the 20% of the subsidiary. So when we add up these two, okay, what we get is the total investment made by parent and subsidiary for the 100% of the subsidiary, 100% assets of the subsidiary. So we can now deduct the net assets of sub or S at acquisition date, all 100%. So this figure coming from working 2. Okay. Now what we'll find, hopefully, is goodwill. But this goodwill, this is what parent and NCI together have paid extra on top of the assets of the subsidiary. Okay, 20% of this goodwill belongs to NCI, 80% is for the parent. So this is goodwill at acquisition date. Right. I'll be happy to take this figure to statement of financial position, show it as goodwill, but something happened to this goodwill since the date of acquisition. The question says, note 3, the goodwill was impaired by 10% at the reporting date. So we need to remove the impairment 10%. So 10% into 7,400. Okay. So 740, and that should give us now the goodwill that we wanted at reporting date. Okay, 6,660. So let's bring that figure to statement of financial position and be done with it. Okay. Good. So we found goodwill. Working 4 is NCI, non-controlling interest. We want to find, see, we have a figure missing in equity section here. Can you see that? Because we are supposed to recognize non-controlling interest as a separate item showing their claim on subsidiaries and assets. So this is going to be working for, we have been working for, aren't we? So how much is that claim? Let's start the story right from the beginning. What was their value at very start? So NCIs at acquisition date, there were 8,000, we know that. Okay. NCI at fair value at acquisition date. Then the share will increase or decrease with the profit or loss of the subsidiary. Okay, so if the subsidiary has made a profit, the share will go up. If it has made a loss, it will go down. So in this case, the subsidiary has made a profit, so we need to give NCI their share in subsidiaries post act profit, which is 20%, remember, into 2,200 coming from working 2. So let's take that and multiply it with 20%. That's not it. Remember, we gave NCI their share in the goodwill. 20% of this 7,400 belongs to NCIs. So if they are getting share in goodwill, they should suffer. So this 8,000 here, sorry to cut, but this 8,000 here includes that goodwill allocated to them. So they need to suffer. If they're getting goodwill, they need to suffer the impairment loss as well. So we are going to deduct NCI share in goodwill impairment. Okay, so that's 20%. Oops. What is happening? 20% into 740. Applying that, so we have given them their share in the loss. So we have now found the NCIs at reporting date. Okay, so where are the NCIs? Right here. Let's put it in. Good. So NCIs are done. Any other missing figures? We have a few, don't we? We have this group retained earnings, we have this investment in associate. There was a PERP, unrealized profit issue lurking around, so we'll deal with that. So let's start with working 5, which is group retained earnings. Now, group retained earnings, imagine it as a pot of accumulated profit that belongs to the group, entire group. That will include the 100% retained earnings of parent. It will include parent share in subsidiaries post-acquisition retained earnings, because they are pre-acquisition retained earnings. We already counted it as part of goodwill working. Remember, working 2 assets, we could complete the retained earnings. So parents' retained earnings will be in the pot. Subsidiaries retained earnings, but only post-acquisition, and parent share. And any share that belongs to parent of associates post-acquisition profits will also be added to this. So that becomes that pot. And any kind of adjustment that affects parents' profit, so like goodwill impairment or say the PERP, will go in here. So let's start with that. So we start with P's retained earning, coming from question, coming from SAP, and we know it was 10,000. So use that. Now let's adjust it with whatever adjustments we need to make. So just like NCI, we need to give parent their share in goodwill impairment. So it's 80% into 704. Okay. So that's done. Then we have PERP, provision for unrealized profit. The question tells us that parent sold goods to subsidiary, so parent made the profit. Subsidiary is still holding 2/3 of the goods, so the goods that subsidiary is holding still contains that profit. So the adjustment needs to be that we're going to reduce parents' profits, retained earnings. So debit parents' retained earnings. We're going to credit subsidiaries' inventory with whatever unrealized profit figure we find. So let's work it out. The total value of the goods sold was 400,000. The profit charge was on that was 25% markup. So markup is when you charge profit on cost of the goods. So this 400,000 is not the cost of the goods, it's the selling price. Okay, so when we apply 25% to 400,000, we can't divide it by 100 to find the value. Yeah, 25%. We need to divide it by 100 plus 25. We assume 100 is the cost, plus we add profit on top, so 125. And then we'll apply the 2/3 to that. Okay, so let's do that. So 400,000, stripping off last 3 zeros, so 400 into 25 divided by 125. If it was margin, we would divide it by 100, but in this case, because markup and because we have the selling price, not the cost, this 25% is not in proportion to the selling price given to us. It's in proportion to the cost, and therefore this 400 actually represents the cost, which is 100 plus 25 profit. That's why this formula, and then 2/3 of the goods. Okay, so that should be, we are going to round it up, so it should be 400 into 2 divided by 3, all right, into 25 divided by 125. Right, this is a long thing, I'm going to round it up. Good, but the whole equation needs to be negative 50 because it's a loss. So we are going to we are debiting parents' retained earnings, and we are going to credit subsidiaries inventories. Okay. All right. Okay, so that's that. And let's start now giving parent their share. Okay, it's percentage in S's post-tax. The same practice as we did for NCIs. So 80% into the difference that we found, 2,200 in working 2. And then we need to give parent their share in A's post-tax. We can work it out. We know parent holds 25% share in associate. So 25% into whatever the post-acquisition profit was. And the associate had made profit of, let's see. So note 1 says, at the date of acquisition, the retained earnings were 300,000. And on the date of reporting, it jumped to 1,300. So that the profit increased by 1,000 or 1 million. So 1,300 minus 300 gives you 1,000. So we can do this in our heads. It's 250, isn't it? Cool. And that's it really. We can add up now and find the retained earnings, rounding it up for the group. Okay, so GRE, group retained earnings at reporting date. Okay, and that figure we can happily transfer to consolidated SAP. Good. And the only last thing left to do now is find investment in associate. And we know parent investment. Okay. Cost, how much they had invested at the start. Right, if we look at parents' books, we know how much they had invested. They had invested 11 million pounds or 11,000. That's their cost. It hasn't been changed since. It will go up or down with the parent share in associates post-acquisition profit or loss. Okay, so we know how much associate has made and how much parent share is. So I can simply copy and paste this in here, right? And the third thing that would change the investment in associate is any kind of impairment, right, or change in their fair value in the market. There is no impairment in that question, but if there is an impairment of associate, that will be deducted from here. So I can do the top add up of these figures and call it investment in associate, in short, so at reporting date. We have another figure as well, so that's cell G40. Right, so now we have everything that we need. We can start closing the brackets and transfer the figures in the main column. 66,000, this one is. Okay, this one is 32,000. Inventory is 14,347. Okay, receivables become 16,600. Cash in bank, we know 4,000. Right, and that should give us the total assets. 150,857. We have finished the equity section. Moving on to non-current liabilities, that will be 32,400, and current liabilities will be 8,800. Okay, and adding up equity and liability side, 150,857. Now balancing, well done. Okay, so it's simple, it's not hard. Consolidated S&P question, you can complete it pretty fast if you know what you're doing. If you know the performance, what additional items would go in your answer, things like goodwill, how to work it out, how to work out investment in associate, how to work out group retained earnings and NCIs. Yeah, all of them are coming from the working. So you can see all these workings that we did become quite crucial, quite important for your answer. Okay, right, so I hope you have enjoyed this video. Try and do this question one more time without looking at the answer, without watching this video. All right, so thank you.